Welcome to this presentation on limits to the use of debt. In our previous presentation, we talked about the trade-off theory of capital structure. We didn't use that terminology because there was no trade-off to be had at this stage. We started off with a perfect capital market. We said that in a perfect capital market, whether you finance your business with debt or equity or any combination of those two sources of finance, it won't do anything to change the value of your enterprise, and it won't do anything to change your weighted average cost of capital. We call those two propositions Modigliani and Miller's Proposition 1 and Proposition 2. The basis for those propositions was that in a perfect capital market, everyone has complete access to information, and that means that households can borrow at the same rate as corporations, and it means that without any tax incentive to borrow money and therefore get an interest tax deduction, investors in a business are going to end up with the same cash flows whether they buy 10% of the shares in a business or buy 10% of the shares and 10% of the debt in an equivalent business that's financed with some debt as well as equity. The other reason these propositions hold is that in this perfect capital market, as I said, households can borrow at the same rate as corporations. You aren't doing shareholders any favours as the CEO by announcing to the shareholders, we're going to borrow money to increase your risk and your expected returns, because households can do that for themselves. Everyone can have their own risk and return preference, and therefore no one is going to pay a higher price for a share in a company that borrows money, because all the shareholders can achieve whatever degree of debt to equity they want in their own personal portfolio. Why does this happen in a perfect capital market? Because the lender to those households could write a contract that says, if you default, we're going to see through you and go straight to the assets of the company that you invested in. And we are going to take those shares and use those shares to pay off the loan. So the default risk of the individual doesn't really matter. And therefore the lenders are only going to assess the risk that the corporation's shares fall below a certain amount, and that's going to be contingent upon the value of the assets of the corporation. So the lenders can be in the same position they would be as if they lent directly to the corporation or they lent money to shareholders to buy shares in the corporation. Their risk exposure is the same. But then we introduced one market imperfection. That market imperfection is corporate taxes. And the way the tax code is written in most countries is that as a lender, as a borrower, the corporation receives a tax deduction for interest expense. And that means that ultimately the shareholders in that corporation receive more cash flows from the corporation for the same amount of risk, as if we were in a perfect capital market situation with no taxes. So all that's ultimately happening is that enterprise value is going up and equity value is going up because there's more cash flows, but there's no increase in the business risk of the corporation. That doesn't mean that leverage doesn't increase the risk to the shareholders in the corporation. We had equations in which we relate the cost of equity capital to the amount of leverage. And those equations said that as you juice up the capital structure, as you put more leverage into the business, you increase the risk to the shareholders, and we can measure the increase in shareholders' required return, which we call the cost of equity, for investing in that leveraged business. But corporations don't finance their entire business with all debt finance. Under this extension to the perfect capital market idea, where we had just one market imperfection, corporate taxes and the tax deduction for interest expense, the implication is that a corporation would finance its business with 99.99% debt finance. It's not 100% debt finance because you have to issue one share in the corporation for our idea of debt versus equity to make sense. But basically the corporation is financing its business with all debt. But corporations don't do that. I mean, even utilities, like DTE Energy or Consumers Energy, they don't finance with 99% debt. They have about 50% debt and 50% equity on a market value basis. The typical amount of leverage for a listed corporation is about 30% debt and 70% equity on a market value basis. So there must be some reason why corporations don't keep borrowing more and more money in order to maximise the value of their business. And the main reason for that is that there are conflicts of interest between shareholders and lenders, and conflicts of interest between shareholders and executives. And it's in this class that we talk about those conflicts of interest. And we come up with a more sophisticated view of the debt versus equity choice that's more consistent with the decisions corporations actually make in practice. So let's talk about that. Let's introduce the idea of financial distress. We've already said that when interest payments are tax deductible, as they are in most jurisdictions like the United States or Australia or Great Britain, there are tax benefits from debt finance. You can deduct the interest expense in filing a corporate tax return. Now, in different jurisdictions, there are more nuanced way of thinking about taxing returns to shareholders, but from the debt perspective, there's basically a tax deduction for incurring interest expense. So corporations have an incentive to take on as much debt as possible. But in reality, what happens if the firm gets too greedy and takes on too much debt, there's some chance of financial distress, and that financial distress can be costly for the firm. And this means that the firm balances tax benefits of the interest tax deduction against these costs of financial distress. And the optimal balance on the tax position of the firm and the likelihood of financial distress leads to a decision as to what we call an optimal capital structure choice, or a trade-off theory. There's a trade-off between maximising tax benefits and minimising the potential of becoming financially distressed, and therefore the expected costs of financial distress, which is the costs of being distressed that we incur on average. So I have to define what I mean by financial distress. You're observing right now a recession. It's a worldwide recession because economic activity is sharply lower in order to mitigate the risk of the transmission of the coronavirus around the world. So restaurants are closed, bars are closed, any personal contact services businesses are closed. So across the world there is a reduction in economic activity for any business which can't operate remotely. Now this could cause some of those businesses to become financially distressed. And what that means is that they won't be able to meet their obligations to the lenders. Now their lenders might incur some extension of credit because it might be more valuable for those lenders to allow the borrowers, the companies, to survive and repay their debts later rather than have the lenders try to take control of the assets if the firms go bankrupt and sell those assets. I mean, after all, who are the lenders going to sell the assets to in the current situation? However, that would mean that if the companies go bankrupt, the shareholders are going to be wiped out. They're going to lose 100% of their investment. But what we mean by the costs of financial distress, it's not what the lenders lose if the firm defaults, and it's not what the shareholders lose if the firm becomes bankrupt. Right? That's an economic loss to those providers of capital. But what we mean by the costs of financial distress in this context is some reduction in business value that occurs at the operational level. It's not a loss per se to the finances of the business. Yes, ultimately a loss in value because operations are affected is going to flow through to a loss in value to the shareholders and the lenders, but we're not talking about how much the shareholders might lose in the event of bankruptcy or what the recovery rate is on debt. What we mean by the cost of financial distress is a reduction in value of the business because three participants, three stakeholders start behaving in really unusual ways. Those stakeholders are customers, employees and executives. When a firm becomes financially distressed, it doesn't necessarily mean it's bankrupt. It doesn't necessarily mean it's missed a payment to a lender yet. It means that there is some reasonable chance that it could miss one of those payments. There is a reasonable chance it could go bankrupt, so it's operating in a sort of distressed situation. Right now, airlines are likely operating in a financially distressed situation. And the fact that they're operating in that distressed state is going to cause their customers, employees and executives to start to do some things they wouldn't normally do if the firm was not operating in a non-distressed state. So first of all, sales are going to fall. I mean, who's going to buy a plane ticket right now for travel in July or August? Right, some brave people might, but even if travel restrictions are reduced in July or August, and they may well be, there's no guarantee that the ticket on the airline that you purchase is going to be honoured. United or American Airlines or Delta, those airlines might go bankrupt. They might not honour the ticket because the airline will then be owned by new shareholders. Now, that's not a fanciful proposition. I'm not saying it's a prediction, but those airlines have gone bankrupt in the past. Now, in this circumstance, they probably won't go bankrupt because it will be more economically efficient for the government to provide them with financing to continue operating than have those companies go bankrupt and have new ownership of those airlines and then restart operations, which will be costly. But the key point is that customers aren't going to buy tickets. And that reduction in the sales is a result of the airline operating in a financially distressed situation. A better example would be if you had American Airlines and Delta being profitable, but United Airlines operating in a distressed state because it had taken on too much debt. Customers would buy tickets on American Airlines or Delta in preference for United because they've got more confidence that their ticket's going to be honoured. Anyone buying some sort of contract with the supplier, like a plane ticket, which I use in a few months' time, or a car which is going to have ongoing warranty obligations, anything in which there's kind of a long-term relationship here between the customer and the corporation, sales are going to reduce if that firm is operating in a financially distressed state because the consumers are going to have less confidence that their relationship is going to continue. The firm may go bankrupt. All right, so that's the first loss in value because of financial distress. Sales fall because customers start behaving differently. But the employees start behaving differently too. Employee productivity falls because employees are aware that the corporation is financially distressed and employees want continuity of employment. So if employees have outside options, they're going to start to look elsewhere and think, well, I don't want to wait until I get laid off from this financially distressed company when it goes bankrupt. I think I'll just start looking elsewhere for a job and try to transition into a better job while I've got some bargaining power. The employee has more bargaining power leaving a current job than having been laid off from a company that's in financial distress when lots of employees are looking for jobs. So employee productivity falls because they're seeking better opportunities. Morale is likely down when a firm is operating in a financially distressed state. There's probably expectations of working more hours or working not for overtime or trying to cut staff, so having the existing staff do more to preserve some cash. That may eat into employee morale and willingness to work as well. So in general, employees operate differently for firms that are in financial distress versus firms that are not in financial distress. Their productivity falls. Finally, executives operate differently for financially distressed firms as well. Their optimal decision when the firm's in financial distress is to preserve short-term cash. And that means making decisions which are not necessarily the highest net present value investment decisions when the firm's operating in a non-distressed state. So, for example, if you decided it was optimal to replace the computers every third year, in a normal situation, that would be a trade-off between saying, well, over time they become obsolete, over time they become slow, over time we can improve productivity by incurring the cost of buying everyone new computers every 3 years for about $2,000 each. Well, in a financially distressed state, you might say it's no longer optimal. It's optimal to keep the existing computers for the 4th or 5th year, even though they're becoming slower, even though we're losing a bit of competitive advantage there, because I want to preserve cash today in order to ensure that I can make my payments to the lenders. Now you can extend this idea further to say there might be some high positive net present value projects which require large cash up front but don't have positive cash inflows for 5 or 10 years' time. Well, you might reject that project in favour of a lower net present value project, but which requires less cash investment up front and provides cash back in a shorter time frame, has a shorter payback period. So this is a suboptimal decision, but it's made as an optimal decision in the current distressed situation. But if I keep rejecting these higher valued projects, that's obviously ultimately destroying value of the assets, because the value of the whole entity is just the sum of the present value of all of its parts. So in short, when a firm becomes financially distressed, employees, customers and executives start making decisions with more of a short-term focus. They start behaving in different ways. That reduces earnings and cash flow for the business compared to a non-distressed state, and that's going to destroy some value. So the executives are going to have to make a decision now, and that decision is going to be represented by an equation coming up. And that equation is going to say that the value of the firm with debt, which we also call the value of the levered firm, is the value of the firm without debt, or the value of the unlevered firm, plus the present value of the tax benefits of debt finance, minus the present value of the expected costs of financial distress. How much does financial distress cost businesses? There's been a few interesting studies. There are direct costs of becoming financially distressed. These are small. They're about 2% of enterprise value. And one study which found the number of 2% was a study by Bruce, Welch and Zhu from 2006. And those authors measured the financial distress direct costs at about 2% by looking at the expense ratios from bankruptcy filings. They looked at how much it costs the firm to pay accountants, lawyers, consultants, other finance professionals, compared to the value of the pre-bankruptcy assets. And paying all those high-value consultants is about 2% of the value of the assets. But it's the indirect costs of financial distress which are more meaningful. These are the incremental costs associated with being in a distressed state, and these are the costs that I was talking about a moment ago, because your customers, employees and executives start behaving in unusual ways. Opler and Titman were the researchers that proposed those three reasons for these indirect costs of financial distress, and they gave them the labels customer-driven response, competitor-driven response and manager-driven response. They didn't mention the employees, but I'm throwing them in this example. The extra example that they have, this competitor-driven response, is that your strong competitors could launch price wars to gain market share. So an example of that in the current situation, even though this is a shock caused by an amazing circumstance of shuttering down bricks and mortar stores, is that Amazon is going to gain large market share. Amazon is going to gain market share in grocery deliveries. It's going to gain market share in all manner of retail goods because it's able to supply consumers with its incredible distribution channel, whereas some of those goods previously would have been bought from bricks and mortar stores. So that's a competitor-driven response. Now, Amazon's not doing anything wrong in this fulfilling demand, but there's a whole host of bricks and mortar retailers who might never recover those customers because they might think, oh, this is quite convenient shopping with Amazon. I haven't bought this many things before. I might continue with this. But in some circumstances, there are in fact price wars. I am the former holder of a ticket on Ansett Airlines, which became financially distressed and ultimately went into liquidation in 2001. It was an Australian Airlines. It became financially distressed. It couldn't pay its lenders and it was hanging on. It was trying to preserve short-term cash. It was deferring maintenance expenditures. It was doing less cleaning on the planes. It was reducing the quality of customer service. These are the employee and manager responses that we were talking about earlier. And consequently, the price of ticket sales was coming down because the quality was declining. But in 2001, there was another dramatic event. That was the terrorism attack that happened on the World Trade Center in New York. And suddenly, global travel fell significantly. And that was enough to, in conjunction with a price war that was going on in Australia amongst three airlines at this time to put Ansett Airlines into bankruptcy. So you had a confluence of events. That you had a reasonably high level of debt, you had a big shock to the travel situation, and you had competitors that were desperately trying to gain market share. And ultimately, the company went into bankruptcy. So, how much are these indirect costs of financial distress? About 10 to 20%. So I referenced a couple of studies on the slide. There is a study from 2006 that I mentioned earlier from Briss, Welch and Zhu. That was about 13% of firm value according to bankruptcy filings. And there was a study by Andre and Kaplan from 1998, which was about 10 to 20% of firm value. Now what these researchers do is they look at the value of the firm before it became financially distressed, and they look at the value of the firm after it became financially distressed. And to measure the value, they look at asset sales as a result of a debt restructure or a bankruptcy proceeding. The reason this study is particularly important is that this group of firms was financially distressed, but they weren't necessarily earning losses at the operational level. Okay, so it meant that their EBITDA, earnings before interest and tax, depreciation and amortization, that number was positive. So if they didn't have any debt finance, so interest expense was zero, if they were all equity financed, they wouldn't have been financially distressed. They would have been profitable at the operational level, at least before depreciation. So they would have had enough cash. However, because they had borrowed a reasonable amount of money, their EBITDA was below what they owed to the lenders in different periods for interest expense, so they were financially distressed. So they could isolate the change in the value of the business from before becoming financially distressed to after they exited that financially distressed state, and that reduction in enterprise value was about 10 to 20%. That's going to be important for some computations which we do a little bit later. So now we get to the equation that I mentioned earlier. And it's so long I'm going to shrink my little video box just to write down the bottom here. So previously we said that the value of the firm with debt, also called the value of the levered firm, was equal to the value of the unlevered firm. That was our perfect capital market situation. Changing capital structure, putting in debt versus no debt didn't change firm value. But then as stage 2, we said if we just incorporate one market imperfection, corporate taxes, and we allow for a tax deduction on interest, we said that the value of the firm with debt is the value of the firm without debt plus the present value of the tax benefits from borrowing. Another way to say that is that the value of the levered firm is the value of the unlevered firm plus the present value of tax benefits from borrowing. But now we're introducing one more wrinkle. There's a negative aspect to borrowing. Now we're saying the value of the firm with debt is the value of the firm without any debt plus the present value of the tax benefits from borrowing minus the present value of the expected costs of financial distress. And what you're trying to do as an executive in this trade-off theory of capital structure is you're trying to maximize the gap between 1 and 2. You're trying to maximize that difference between the incremental benefits that you get from borrowing and the present value of the expected cost of financial distress. So you want to take on debt to the point where the marginal tax benefits of an additional dollar of debt equals the marginal costs of financial distress. Now what that means is that you take on more and more debt until the incremental benefit of one, the extra benefit you get from a tax break, is just offset by the incremental present value of the expected costs of financial distress. Can that equation be solved with a great degree of precision? No. It's not easy to say with certainty, well, given my equation here, the optimal capital structure is 30% debt, 70% equity. But just because we can't answer that question with a great deal of precision doesn't mean that we can't attempt to address it. You can't ignore important capital structure choices just because they're hard to estimate. So, for example, we estimate discount rates. We can't estimate discount rates with a high degree of precision either, but we need a discount for present value computations. We can't estimate long-term growth rates with a high degree of precision, but we need to estimate those. Some analysts and investment bankers and consultants, whatever you want to label them, they say, well, because we can't estimate things with a great degree of precision, let's try to adopt techniques which get around this problem of estimation. And one thing that they typically do is say, let's forget all this stuff about discounted cash flows. Let's rely almost exclusively on multiples. And that would be fine if you could estimate the appropriate valuation multiple for a business with a high degree of precision. But you can't. Because the valuation multiple, which is appropriate for a business, embeds all that imprecision in discount rates and long-term growth rates and corporate tax rates and all the uncertainty over long-term cash flows. So, for example, suppose I said I'm going to estimate enterprise value as 10 times next year's EBITDA. Okay, well that's fine. But how did you get the number 10? Well, I looked at a series of comparable firms. Well, how do you know that those firms are highly comparable? Did you have a dozen of them? Typically not. Typically you don't have a dozen highly comparable firms. Are you sure that the EBITDA estimate you got for those firms is an average of what you would normally expect 1 year out? How do you know that some of those EBITDA estimates are not affected by something unusually good or bad that happened in that first forecast year? How do you know that the company that you're analysing has an EBITDA projection which isn't unusually high or low in any given forecast year? And the answer is typically to say, well, I normalise them. Right, I've come up with what I expect to observe on average over a long period of time. And the response to that is to say, so wait a minute, you have a technique that you can use to estimate what you think is going to be the cash flows which the business generates on average over a long period of time. If you have such a technique, can't we just go back to discounted cash flows? Can't we use both multiples and discounted cash flows? You said the reason you want to use multiples is because you didn't have a technique for estimating with reliability the appropriate cash flows over a long period of time. And the multiple itself is contingent upon risk. If it's a risky business, you would have a lower multiple because investors will pay a lower price for a risky business compared to a high business, compared to a low-risk business. So discount rates and growth rates and all the other assumptions we have about cash flows are ultimately embedded in valuation multiples. And that's why we want to use at least two valuation techniques, discounted cash flows and valuation multiples, for estimating the value of a business. So getting back to our equation here, can this equation be solved with a great deal of precision? No, it can't. But then what am I to do as an executive? I have to make a decision about how much leverage to take on. Do I take on $10 billion of debt, $20 billion, $30 billion? I have to make a choice. There's no default position. There's no hands-off choice where I say, well, I'm just not going to make a decision on this. I'm just going to choose the default position X. Right? That's not really an option. There has to be a choice. And this is a useful way of making this choice, by trying to quantify this gap between the present value of the tax benefits from borrowing and the present value of the expected cost of financial distress. So let's do this in an application. We're going to come up with an application to quantify this gap as represented by the chart you see here. As debt increases, the value of the unlevered business remains constant, but the value of the business with debt increases. So this straight line represents the relationship between enterprise value, also called firm value, and debt for the situation where we only had one market imperfection, corporate taxes and the tax deduction for interest. This gap between the curved line and the straight line represents the present value of the expected financial distress costs. What you're trying to do is find the point here at which you maximise the value of the levered firm. At that point there, this level of debt, I'll just call it D star, that level of debt is your optimal capital structure choice. At that point, the incremental benefit you get from that extra tax deduction is equal to the incremental loss you get from expected financial distress costs. So in other words, the slope of this curve is 0 at that point. That's our choice. We're going to illustrate that with CVS. What I want you to think about when you're considering the expected financial distress costs is the term expected. In different parts of the course, we have considered expectations. We considered expected returns on investment. We considered, I guess that's the only one point we considered it. Expectation is a statistical term. It means a probability weighted average of possible outcomes. So if you think back to our discussions of risk and return and portfolio theory, in some examples we had scenarios. We said, for example, there's a 30% chance of a boom scenario, a 40% chance of a normal scenario, and a 30% chance of a recession. And we had returns on a portfolio or an individual investment that we would expect to observe in those 3 different scenarios. And we asked questions like, well, what do you think is the expected return on the asset or the portfolio? And we said, well, the expected return is a weighted average of the possible returns. So you would take the 30% chance of the boom economic conditions times the return you would observe in those boom conditions, plus 40% chance of normal conditions times the return that you would earn in those normal conditions, plus 30% chance of a recession times the return that you would earn in the recession. And the weighted average of those returns was your expected return. So expectation means the probability weighted average of the possible outcomes. Well, in this situation here, we have to come up with the expected costs of financial distress, which means we have to measure the probability of becoming financially distressed and the potential loss in the event of financial distress. Now, the flip side of that, the probability of not becoming distressed, if that happens, well, there's no loss from financial distress. So the expected cost of financial distress is the product of the probability of becoming financially distressed multiplied by the value you would lose if distress occurs. Now, in the prior studies that I mentioned, in particular Andre and Kaplan's study, they measured a 10 to 20% reduction in firm value for firms which were financially distressed. So, for example, if you were a $100 million firm in terms of enterprise value before becoming financially distressed, we would anticipate that if you become distressed, your firm value will be reduced by $10 to $20 million, down to $80 to $90 million. But that's not the expected cost of financial distress, because there's only some probability that you become financially distressed. What are those probabilities? In our discussion of the cost of debt, we had a table where we had credit ratings going down the vertical axis, and we had time horizon going across the horizontal axis. And what I showed you in that table is the proportion of bonds with different credit ratings that defaulted on their debt over different time horizons. So, for example, in that table, for a bond initially rated BBB, the probability that that bond misses at least one interest payment over the next 5 years was about 2.5%. Now, I recently looked at an updated version of that table from Standard & Poor's. The probability of a BBB rated bond missing at least one interest payment over the next 5 years is now about 4%. So if you started with 100 BBB rated bonds, over a 5-year period, you would anticipate that 4 of those are likely to default at least once on a payment to a lender. So that's going to give us some flavour, and again, this is just an introduction, so it's not particularly sophisticated. It's some flavour of the probability of becoming financially distressed. In my example, I'm going to assume that the probability of financial distress for this company is going to be 6%, and what the company is going to lose if it becomes financially distressed is $20 billion. So assume that I've just done some very detailed analysis to come up with those numbers. They're approximately, what you would get from that Standard & Poor's analysis and the on-rating capital analysis from the previous slides, but I've just invented these numbers for the purpose of the example, but they are economically sensible assumptions. We're going to consider CVS again, which we considered in our previous presentations. When I did the analysis, the share price was $54.73. The company had 1.3 billion shares on issue, so its market value of equity was $71.1 billion. Assume, for simplicity, CVS has $73 billion of debt, and it's going to maintain the same amount of debt in dollar terms every year. Now remember, whether a company maintains the same debt in dollar terms or maintains the same debt to enterprise value in percentage terms over time is crucial for deciding what this is ultimately going to mean for the cost of equity. We had different equations there depending upon our assumption regarding debt going forward. The enterprise value, the sum of the value of debt and equity, is $144.6 billion. CVS has a BBB credit rating. Its cost of debt is 5%. The cost of equity is 9%, and the corporate tax rate is 21%. What we're going to do is answer the following questions. What's the weighted average cost of capital in the first year? It's going to be different in different years because enterprise value is changing, but the amount of debt in dollar terms is staying the same. So the leverage ratio is changing each year, and therefore the weighted average cost of capital is changing each year. So we're going to ask, what is the weighted average cost of capital in the first year? We're going to estimate what is the unlevered cost of equity. What you see here for 9%, that's the cost of equity for CVS with debt. That's the levered cost of equity. We're going to estimate the present value of the tax benefits of debt finance. We're going to estimate the expected cost of financial distress. And we're going to estimate what the enterprise value of CVS would be if CVS had no debt. So at the moment, in terms of our equation, we have the value of the levered firm. And that number in our example is $144.6 billion. Because this is the value of CVS with debt. We're going to estimate what is the value of the unlevered firm, what is the present value of the tax benefits from borrowing, and what is the present value of the expected costs of financial distress. So we're going to decompose the value of the levered firm of $144.6 billion into those three components. So first of all, what is the weighted average cost of capital at the moment? Our equation says that the weighted average cost of capital is the cost of equity times the proportion of equity finance plus the cost of debt times 1 minus tax rate times the proportion of debt finance. CVS has 51% debt and 49% equity finance, and so its weighted average cost of capital is 6.44%. All right, that was the easy part of this analysis. Something which is a bit more complicated is coming up with the unlevered cost of equity. Now, our equation for the cost of equity for a firm with debt, or the levered cost of equity, was cost of equity for the levered company is the unlevered cost of equity, or REU, plus the cost of equity for the unlevered business minus the cost of debt times the debt to equity ratio times 1 minus the tax rate. Now, as a recap, why does 1 minus tax rate appear in this equation? It's because we assumed that CVS is going to maintain a constant dollar amount of debt in every year. If we made the alternative assumption that the percentage of debt to value was going to be maintained at the same percentage every year, 1 minus tax would disappear from that equation. And you must know the implications of those assumptions. If I rearrange that equation with a bit of algebra to get the cost of equity for the unlevered firm on the left-hand side, that equation would say the unlevered cost of equity, or REU, is equal to the levered cost of equity, that's REL, plus the cost of debt, or RD, times the debt to equity ratio times 1 minus the tax rate, And all of that would be divided by 1 plus the debt to equity ratio times 1 minus the tax rate. If you put our assumptions into that equation, you end up with a 7.2% unlevered cost of equity. So to recap, the unlevered cost of equity is 7.2%. If CVS had decided, I'm not going to take on any debt, then the shareholders would expect to earn a return of 7.2%. But because CVS took on quite a high degree of debt, $73 billion, so it's got a 51% debt funding and 49% equity funding, the cost of equity jumped to 9%. And that's what we could measure with our capital asset pricing model, for example, by estimating risk-free rate and beta and market risk premium. That incremental return to the shareholders of 1.8%, that is the extra return the shareholders anticipate receiving because of their increased risk exposure, because of that financial risk. Now, I say again, don't do the following equation. Don't do this. Often bankers want to use this equation. They want to say that the unlevered cost of equity is equal to the levered cost of equity plus RF times debts to equity divided by 1 minus tax rate, and all of that divided by 1 plus debts to equity times 1 minus tax rate. Now, they don't normally write it using the cost of equity. They use asset beta. They use the beta version of that equation. Remember we talked about there's always a beta version of these equations? The bankers will use this equation. They'll say the asset beta, which matches onto the unlevered cost of equity, is equal to the equity beta, which matches onto the levered cost of equity. There'll be nothing over here. Right, this will be blank over here. There'll be 0 here. Divided by 1 plus the debt to equity ratio times 1 minus tax rate. So the bankers will say asset beta is equity beta divided by 1 plus debt to equity times 1 minus tax rate. The reason I'm saying don't do that is because that equation is based upon the assumption that the cost of debt is equal to the risk-free rate of interest. And in the bankers' modelling everywhere else, they will assume the cost of debt is above the risk-free rate of interest. So that embeds an inconsistency in their analysis, and that will lead to them making valuation errors. The key point is that you must be consistent with your assumptions throughout all of your analysis for a corporation. You can't decide in estimating discount rates for the weighted average cost of capital that the cost of debt's above the risk-free rate, but in doing some other computations that the cost of debt is equal to the risk-free rate. You can't believe two things. So that was our second question. Unlevered cost of equity is 7.2% compared to the levered cost of equity of 9%. Third question, what's the present value of the tax benefits of debt finance? Well, that's an easy one. We said that if you make the assumption that the company is going to borrow a constant dollar amount of debt and maintain that dollar amount of debt in time series in perpetuity, the present value of the tax benefits of debt just collapses to be the tax rate times the amount of debt. In this example, that's $15.4 billion. How did we get that equation? Well, let's remember, we said that we have to think about borrowing as a project. The decision to borrow money generates extra cash flows each year, and those extra cash flows are equal to interest expense times the tax rate. And that series of cash flows continues in perpetuity. Well, if I have a zero growth perpetuity, to get the present value of that zero growth perpetuity, I divide by a discount rate. What do I think is a fair discount rate for this zero growth perpetuity? Well, I made the argument to you that if the corporation has a constant dollar amount of debt in perpetuity, then the risk of the tax deductions on the interest expense is about the same as the risk of the interest expense itself. and the market's already worked out a fair interest rate to come up with the interest expense, it's probably a fair discount rate for the tax benefits on that interest expense. So we said that the value, the present value of the tax benefits of debt could be equal to interest expense times tax rate divided by the interest rate on debt. And interest expense is the amount of debt times the cost of debt. Okay, that's interest expense. The tax deduction on that is interest expense times the tax rate. And the discount rate is equal to the cost of debt itself, because the tax deduction and the interest expense, they have about the same risks. So RD cancels out, and we say that the present value of the tax benefits of debt is equal to the amount of debt times the tax rate. And in our example, that's $15.4 billion. Now that doesn't work if you assume that the company is going to maintain a constant percentage of debt. We have to do another computation there, but this is going to work in this particular assumption. Fourth question, what is the expected cost of financial distress? Well, we made an assumption that if this business becomes distressed, its value is going to fall by $20 billion. There's a 6% chance of becoming distressed, so the expectation of the cost of financial distress is $1.2 billion. Now that's already a present value computation. The $20 billion figure wasn't an annual cash flow. That was already a present value computation. So the expected cost of financial distress in present value terms is $1.2 billion. So then finally we can address the question, well, what would have been the enterprise value if CVS didn't take on any debt? What would have been the unlevered enterprise value? So we have our equation, the value of the levered firm is the value of the unlevered firm plus the present value of the tax benefits of debt minus the expected cost of financial distress. If we put some numbers into that equation and rearrange it, we would say that the value of the unlevered firm is going to be $130.3 billion. So what this means is that CVS, if it had not borrowed any money, would have been worth $130 billion as its enterprise value. The debt would have been zero, so equity value would have also been $130.3 billion. Because CVS took on debt of $73.4 billion, enterprise value went up by to $144.6 billion. It went up by $14.2 billion because it received the tax benefits of debt. In present value terms, that was worth $15.4 billion, but that was offset by the expected cost of financial distress. And that gap there is about $13.2 or $13.3 billion, depending upon rounding. With debt of $73.4 billion, equity value is now much less. It's only worth $71.1 billion. But this decision to take on debt didn't harm the shareholders. The shareholders are going to, suppose CVS started with no debt and decided we can provide benefits to shareholders here. If we borrow money of $73.4 billion, we can use that money to pay a special dividend to the shareholders or do a share repurchase. After we do that transaction, the shareholders will have $73.4 billion of cash in their pocket, and they'll have shares remaining worth $71.1 billion. So the value to the shareholders will increase from $130.3 billion up to $144.6 billion. In other words, the shareholders will capture that gap between the tax benefits of debt finance and the expected cost of financial distress. So that's our first sort of comprehensive example of how this trade-off idea works. The corporation will consider many different debt amounts, and ultimately there'll be a point at which taking on more debt starts to become counterproductive. There'll be a point at which you could take on more debt, you're going to get more tax benefits, but the expected cost of financial distress will become so large that it's not worth that additional borrowing, and that will become the optimal capital structure. To this point, we should really pause for a moment and we will return with a discussion of optimal capital structure incorporating conflicts of interest between shareholders, lenders and executives.